Hello and welcome to the Oanda MarketPulse morning market snapshot. My name's Craig Erlam, Senior Market Analyst at Oanda. Now, as you can see, we've had plenty of economic data out already this morning. They're primarily focused on the UK inflation outlook, and we can see already that the overall CPI reading was minus 0.1% year on year in October, in line with what we were expecting and also in line with what we had last month. Now, we're still seeing the same real deflationary pressures, or predominantly the same deflationary pressures, the most obvious being energy prices continuing to wane. Now, this is expected to phase out as we near the end of the year and move into next year, because we are now approaching a year since energy prices started to fall so rapidly. So hopefully that should start to phase out of this CPI reading. We should start to see some higher figures, well, especially move away from deflation territory, which we currently find ourselves in. Core inflation was at 1.1%, which is why we saw a bit of a bounce in the pound shortly after the economic release. But again, the theme just still really remains the same. These deflationary pressures are temporary, and more importantly, they're actually stimulative for the UK economy. The bulk of the deflationary pressures coming from lower energy prices and lower food prices, and in the short term, at the very least, that continues to be a positive thing, as long as it doesn't start to influence consumer inflation expectations, at which point that's when you start to see spending habits start to be affected, and that can have a longer term detrimental impact on the UK economy. Now, also today we had the ZEW economic sentiment figures for the Eurozone and also Germany, and as you can see again, these were slightly weaker than expected in terms of German current sentiment and also overall Eurozone economic sentiment. But the economic sentiment from Germany, the powerhouse of the Eurozone, was actually stronger than expected at 10.4, so a nice rebound in Germany in November, and hopefully we can see that continue into next year, given the fact that it has been a very soft economic recovery in terms of the Eurozone so far this year, and we are hopefully expected to pick up moderately, but I think overall the pace of growth is expected to remain very moderate in 2016, slightly better maybe what we've seen in 2015. In the US, we've got inflation data out this afternoon as well, and there's going to be a big focus on this economic data because of the fact that we are expecting the Fed, unlike the Bank of England, we are expecting the Fed to actually raise interest rates in December, possibly that's obviously in a month's time, but at the very worst probably in the next few months. We are expecting these inflation figures to be weak. We're expecting the overall rate of inflation to be at 0.1%, again being driven lower predominantly by lower energy prices, but these are seen as transitory by the Fed, and core inflation according to the CPI reading is at 1.9%, so not far from the Fed's 2% inflation target. Now, it's important to realise that this CPI reading is not the Fed's preferred measure of inflation, but it is the earliest indication of inflation that we do get, so it is still very much a key focal point in terms of investors, and we can expect to see some response to this in the markets. Now, speaking of the markets, let's take a look at some charts. And a couple of what that I wanted to highlight here. One was gold, because we have seen a bit of volatility in gold in recent days following this long sell-off. It appears to have found some form of short-term trading range between 1070 and 1100. 1070 proving to offer support 5 days ago, and 1170 yesterday when we saw that rally initially off the back of risk aversion, but then we have seen that stabilise once again. These going forward is going to be two key boundaries for me. If we see a break above 1100, that would suggest to me that we may see a more prolonged period of correction. If we see a break below 1070, then I'll be looking back towards the 1000 level, which is going to be a massive psychological level for gold. The other one I wanted to highlight is WTI, because we did see a rebound here yesterday, which actually seemed to lead a lot of the gains that we saw in equity market indices as well. The oil and energy stocks in particular really driving the gains yesterday. But we've approached this 42.20 to 43.20 level, which previously throughout the months of September and October were significant support levels for WTI. Now, we have approached this level again and run into resistance around here. We are seeing it trading slightly lower on the day again today. And if we take a look at the 4-hour chart, we aren't necessarily gaining any significant momentum as of yet. And to be honest, the momentum seriously, even now, seems seems to be against any further downward move. So I am a little bit cautious when it comes to WTI, given the significance of the sell-off we saw when we had 8 consecutive trading sessions to the downside, only one correction session so far. If we see these previous lows taken out, these 40 again, a big psychological level, then I will become more bearish and start to look back towards this year's lows around 37, or just above 37. But I am a little bit cautious at this stage just because the momentum doesn't seem to be with that move. The final chart I wanted to highlight is euro-dollar, just because we are trading around this 106.50 level again, prior support, but again momentum doesn't appear to be with the move. So while we may see a move back towards these 105.20 to 104.50 to 105.20 levels, I'm not saying that's not going to happen, and we have seen the prior lows taken out, so that would suggest that there's potentially more downside to come here. We've also seen these lows from the 21st of April taken out as well, so that suggests that there may be more downside moves to come. But I just wanted to really highlight this momentum shift from the bears. It's less favourable for the bears, should we say. That doesn't necessarily mean we won't see further downside immediately, but it would suggest that momentum is running out. So this is a bullish divergence, which may suggest again strong sell-off that we've seen in euro-dollar. It may start, we may actually see some form of prolonged consolidation or correction fairly soon. For more in-depth news and analysis, check out Oanda MarketPulse at marketpulse.com. You can also find out more about Oanda and sign up for a free demo account at oanda.com. Here you'll also get access to Oanda Forex Labs, which has a lot of great tools aimed at helping you in your trading.